Hi there. Welcome back. This is the E.M.I for the month of June 2026. So let's jump right in. In this month's E.M.I, as usual, we make a number of observations. We see how emerging market outperformance with the US pivots with just one stock, while India is more broad-based. We noticed that PMIs remained positive, while urban indicators were seen soft alongside mixed employment indicators. Geopolitical uncertainties kept equity markets rather choppy. We take a quick peek into global domestic returns, flows, currency rankings, valuations, sectoral market breadth, and much more. On investing, we examine what post-tax investment returns at the top tax bracket looks like. We also see how investment returns post-tax and inflation looks like. Emerging market outperformance versus the United States pivots with just one stock. India remains relatively broad-based. Emerging market outperformance versus the United States pivots with just one stock. You heard that right. For a while now, markets have witnessed the narrow breadth of US equity returns, concentrated in a handful of names, like Magnificent Seven. Broadly, the AI trade. And this chart shows that the EM's ongoing outperformance rally is no different, and most of the return heavy lifting appears to be on the shoulders of a single stock, South Korea's Hynix. India, on the other hand, is a domestic story, broad-based, and does not rely on the AI supply chain for market leadership. India has sat out of this structural rally and therefore carries much lower concentration risk. Memory as a segment is seen as the most cyclical part of semiconductors and are at times seen like commodities with apparently predictable and repeating boom and bust cycles driven by supply and demand. Because new capacity takes years to build, supply tends to overshoot demand when it comes in large lumps. While memory is cyclical on the supply side, logic is also cyclical but on the demand side. Coming to India, what becomes more relevant for now is last week's RBI's policy that has greatly helped address concerns around the currency. And if crude prices witness normalization even as late as September-October this year, ahead of the US midterm elections, this would be the second and probably a key positive trigger after the currency that could make India look increasingly attractive for FIIs. Let us now take a quick look at how some key short frequency macro indicators looked like. PMIs remained positive while wholesale inflation reflected crude pressures. E-way bill momentum and labor market composition appeared mixed. Urban indicators were seen soft except continued MUV sales growth. Gross FDI inflows remained strong and continued strength was seen in ECB inflows. Let us now shift to the markets before we look at returns and valuations. Let us see how Nifty performed in March. Nifty delivered minus 1.9% returns in rupee terms for the month of May. Mid-cap outperformed small-cap while the BSE 500 was seen marginally negative with the Nifty seen well below. Korea, Japan and the US continue to top in May alongside metals. 3-month returns show continued EM pressure with the Korean exception. May equity returns were completely off averages. Cumulative FII inflows were seen tagging 2022, while domestic institutional investors were seen significantly stronger. FIIs added power and capital goods in 3 months. Outflows, however, were seen from financial services that remain. RBI measures set to help improve rupee's rank further from 11 out of 23. Valuations continue the trend of moderation in May. Sector-wise breadth of market momentum showed that financials have seen the largest drop in market momentum and metals appear to have driven the recovery in breadth along with healthcare and industrials. Now we come to the last segment of E.M.I, What must you know before investing? What do post-tax investment returns at the top bracket look like? A 20-year-old young investor with rupees 10 lakhs lump sum would touch 9.3 crores by the retirement age of 60 years. However, if one were to reduce taxes at 30% on retirement day, the corpus value drops to 6.5 crores. However, if instead of paying taxes at the time of retirement, if taxes were paid every year instead, the corpus value drops sharply lower to rupees 2.5 crores. Why? Because paying taxes every year eats into the profits that get added to the principal every single year. How do investment returns post-tax and inflation look like? A 20-year-old investor with 10 lakhs lump sum would touch 9.3 crores by the retirement age of 60. However, if one were to reduce taxes at 30% on retirement day and also adjust for inflation at 6% CAGR, the corpus value drops to 64 lakhs. However, instead of paying taxes at the time of retirement, if taxes were paid every year instead, the corpus value drops sharply lower to 24 lakhs. Till next time, this is Arjun signing off.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.